Good morning, ladies and gentlemen, and welcome to the Century Management Annual Review. We have a lot of things that we've thought about that we want to share with you this morning. So we're going to start off with our first slide, and here's the way this got started. What we did is we pulled all of our analysts into a meeting one day, and we said to them, we're going to be putting on a client review. We want to be able to look people in the eyes and tell them that all the problems that are out there that you know about, that we have factored those into the stocks so that we can tell them with the insurance that we have covered these things. So the first thing we did is we put all the problems on the board. And there's quite a few problems, as you know. So we put all the problems on the board and we categorized them into two sections. One, the first section is that some of these problems are already priced into the stocks. When you have a slow economy or you have a recession, the earnings comes down, the sales come down, the balance sheets gets turned around. So a lot of that is already figured in on what these companies are earning. The first thing we talked about is the slow growth economy. That's already factored in. High unemployment, that's been going on for several years. High national debt, that's been climbing for the last few years. The Obamacare, the slowdown in Europe, and the slowdown in China. So these are things that we're very much aware of are already factored into the stocks. What is not factored into the stocks, which is the next slide, is the fiscal cliff, the European breakup, the Chinese real estate bubble, potential military action in the Middle East. And I had recession, inflation, but I've removed the deflationary threat because while we were very worried about deflation in the last couple of years, we are no longer concerned about deflation as much because of the fact that the way the Fed is printing money and the way that the ECB and all the European countries are printing money. So the thing that's not factored in is a major recession and inflation. We'll talk about the inflation a little bit later, but let's start with the first one, the fiscal cliff. I'm sure you've been reading a lot about the concerns both from Chairman Bernanke and other people in the government, the fact that 10 years ago we had tax cuts and they're coming due in 2013. So there's going to be huge tax increases. There's also a commitment that they have to cut government spending, and that's all going to come due at the end of this year. What that does is it takes $500 billion out of the economy. That is almost 3% of GDP. So when you take $500 billion out of the economy that is only growing 2.5%, you're almost guaranteed to have a recession because it's going to take 3% out. We're only running at 2 to 2.5% anyway. So that is the major concern that you read about every day, that what happens if there's a fiscal cliff. If they don't do something about it, you can almost guarantee yourself a recession. Here's the alternative. If they postpone it, and they're talking about that, every year that they postpone it, it's going to cost us $500 billion more on the federal debt. If they postpone it for 2 years, it's $1 trillion more on $16 trillion of debt already. If they postpone it for the entire 10 years, it's $7.5 trillion. I've read all of the things that have been published by the Federal Reserve and different agencies. I think the way it's eventually going to come up is they're going to have to compromise. They can't do it all at once. They're going to spread it out. If they spread it out, they will be able to avoid a recession, but they won't be able to avoid adding a couple of $1 trillion to the federal debt. So that's the way it is right now. In our thinking, we are factoring it in as if it could happen. So we are factoring into our stock prices that if we do hit the fiscal cliff, there's going to be a recession, and that's going to be factored into what we call our worst case. Europe is the next thing that is not factored in. We have factored in the slowdown. There's a major recession going on in Europe. They've got a lot of problems. There's 17 nations who've agreed to work together. But what they are finding out that there's a lot of things they haven't agreed on, and that is how to discipline each other. That's going to take years to work out. So if there is a breakup of the euro market, one of the 17 nations leave, it'll create tremendous disruptions. Those disruptions will slow everything down. And again, since we're teetering so close to a recession, I'm not saying that that will tip us into it, but it certainly could cause it. So we're aware of that. But here's one of the things, and I was really amazed as I was doing the research on it. What is really amazed at how misled you can be by reading the newspaper. When you think about the European crisis, you would think that the exports to Europe would be falling off the cliff. We export about 13% of our GDP. In other words, all of the sales we do, about 13% is spread out throughout the world. Europe is a major trading partner. We trade about 26% with them, which is around $400 to $500 billion. It's also about 2 or 3% of our GDP. What is amazing about these statistics, as bad as Europe is, we are actually increasing exports to Europe. At the bottom, we did $467 billion in exports to Europe. At the peak, it was $557 billion, and now we're almost back to the peak of $567 billion. So despite all the problems and things you hear about Europe, and they're all true, the way it is affecting America is completely different. We're actually able to expand the exports to Europe, and later on when we deal about the revival of American manufacturing, you're going to see why that our productivity is starting to outpace our partners, and we are picking up the marginal sales out to Europe. So that is good news for America. It's not necessarily good news for Europe. They still have to deal with their problems. The main thing is it's this disruption of the currencies if they break apart. The next thing that we're going to talk about is China. That's also a major problem. Now, China's been slowing down from a very rapid growth, and they're still growing at a tremendous pace. That is already factored in. What is not factored in is that China has one of the biggest real estate bubbles that probably ever existed in the planet. They literally have cities where only a few 100,000 people are living, and there's overbuilding for a capacity of almost 1 million people. They have built airports, they've built all kinds of infrastructure, and they keep building it even though it may take 10 or 15 years to fill that up. This is all done by bank loans, and as you all know, living through our real estate bubble, when that bubble bursts, and we don't know when it's going to burst, but somewhere down the line, all bubbles do burst at some point. There's going to be a lot of pain and a lot of blood in the streets in China. Fortunately for America, China only represents 6% of our exports, about $140 billion. So the fact that China is slowing down is not necessarily going to hurt our exports that much. It's such a small percentage. The turmoil in the financial markets is what we're concerned about, and those are some of the things we're talking about now. The final problem that we put on the board is something you can't predict, and that is military action in the Middle East, namely Israel attacking Iran because of the nuclear problem. We don't know whether that's going to happen. Nobody knows, but we do know that that'll be disruptive. If you think about 9/11, that is a very dramatic example. I don't believe that a military action against Iran is going to have the same effect. But one of the things that we're factoring into our thinking is that if it does happen, you're going to have an increase in the price of oil. So those stocks that are concerned with the price of oil, obviously they're going to be affected. Some of the other stocks will not be affected. When you boil all the problems down, if you put all of them together, you realize that many of the things we're reading about are already in the price of the stocks. The thing that we have to be concerned about is the ones that we are not reading about. And those things, if I boil them all down, it means that any one of those issues could turn us into a recession. So the big concern that we have today is when you boil all these problems down is any one of them is enough to tip us into a recession. So we've done a lot of work on our stocks to say what would happen to the individual stocks if we go through another recession. Now bear in mind, we are not predicting that. We don't know what's going to happen or how these situations will unfold. What we do know is when you're running at 2.5% to 3% of GDP, and any one of them can lose 0.5% to 1%, you're getting very close to a situation.